Both valuation of market value and a calculation of worth calculate the present value of the expected cash flow from the property investment. The difference is that valuation of market value uses market-derived information to assess the capital value of the asset, and the calculation of worth uses owner's specific forecasts to determine the attractiveness of the investment relative to its market value. In video 1, it has been established that different investors choose different benchmarks by which to judge the attractiveness of an investment. Although these different yields might reflect different aspects of the investment's attractiveness, they are related. The two yields that are used to assess the attractiveness of an investment at the commencement of the investment period are the initial yield, K, which is the initial rent expressed as a fraction of the purchase price, and the target rate, E, which is the overall return that will be achieved if the investment performs as predicted. It is possible to analyze the relationship between them. The all-risk yield, which is derived from the initial yield of a rented property. In the traditional method of valuation, it will imply growth expectation, either positive, negative or zero, at a certain level. If an investor is requiring a certain overall return from the property, then there is a relationship between the three variables: initial yield, target rate and growth. So, the growth may either be in the form of an increase in the income flow over the period of the investment, or an increase in its capital value, or both, and this would be viewed as the total return, income return plus capital return over defined investment period. The relationship between the initial yield and the target rate of return. In order to understand the relationship between the initial yield and the target rate of return, we compare them excluding the impact of inflation and real growth. Note that the capital value of the bond investment is higher than that of the property investment because the cash flow from a property is riskier and therefore it is less valuable. This is reflected in the valuation by using a higher yield, meaning that we use a lower multiplier in the equation. So, assuming that the market has no growth, then an investor considering purchasing a property for investment instead of a government bond will assess their target rate for the property by reference to the current risk-free rate. If a bond is producing a nominal return of, say, 4%, then this would be adjusted upwards to reflect the additional risk of property investments. The property yield used to capitalize the income might be a target rate of, say, 5%. As the income is not expected to change over time, then the annual yield would be the same every year. Therefore, the initial yield, K, would be the same as the expected overall return, E. Now, assuming that both inflationary and real growth exist in the market, then valuation method does not use a yield derived by reference to other investments, the target rate, and starts to rely upon initial yields derived from an analysis of recent similar property sales as the benchmark for comparison. The use of initial yields meant that the capitalization rate is reduced, possibly even to below rates prevailing on non-growth risk-free investments, like government bonds. This in turn means that as the multiplier is the reciprocal of the capitalization rate, the multiplying factor years purchase is increased accordingly. The higher multiplier is then applied to the initial income from the property and a higher value result. This reflects the additional price an investor would pay for an investment where incomes could grow, over the corresponding price of a fixed income flow with the same initial income. If you have found this video useful, please like, share and subscribe for more videos and write your comments or questions.